Good afternoon, everyone. I've been told to entertain you until everyone sort of is done with lunch, and I have no clue how to entertain people. So, we still sort of go back to maybe some tales that we otherwise would not share with anyone. So, Lakshmi, first question to you, since sort of we worked together. She used to be my client. We've worked together for about 25 years now. Then we became competitors. And we fought hard with each other on almost everything, every second day, third day, or for something or other, on regulation, on performance, on whatnot. And then, of course, now she's telling me today that, you have to grow to deserve to be my client. So I think we have a role reversal now. But nonetheless, Lakshmi, if you sort of look back in 25 years of your journey, something that you want to share with people that you've never shared with respect to, your experience in the markets. Something that you've sort of gone through, you experienced, some exotic stuff in the market, which you've never shared, you would like to share with people. And it's not going to be any story that you've told to anyone.
इसने पहले बॉल में ही गुगली मार दी एंड दैट इज टू अ पर्सन हु डजंट नो हाउ टू प्ले क्रिकेट तो सोचो हाउ द रेस्ट ऑफ द सेशन इज गोइंग टू गो anything which exceptional which you're saying which the market
some exotic tale that entertains people.
Which what?
That entertains people.
Entertains people. I think what entertains people is returns. I think that is what people are here for. And I was entering with a mindset of probably asking Maneesh or Bhavdeep or Karthik for that matter कि would we be in a situation as panelists to ask इतना सन्नाटा क्यों है भाई ये तो alt का conference है mutual fund का नहीं है. But after seeing this houseful audience, I think I have to think of much different dialogues. But the reality is that every day is exceptionally exciting. Every day there is something exotic happening and you are as good as your previous day. Like as I say in the game of golf. Golf is a game which is very close to my heart. And if you give the golf analogy, you really know that you're only bettering yourself in the game. And I think that's what the market teaches you every day.
No, so she's not telling, that I'll tell.
ये अंदर की बात है.
But okay, so is it true, Karthik, that it's all about performance? We're just warming up because, people are not done with lunch yet. Is it true that it's all about performance or it's like Lux that it's a filmi sitaro ka sabun? Actually, it's caustic soda, but actually, it's all about branding.
No, I think at the end of the day, it is all about performance. So I think, obviously as an industry, we are custodians of, money for investors. So at the end of the day, I think returns is what is important. And now when you say returns, I think it also implies the consistency of returns, the structure of the returns in terms of capital protection. So the first things we get asked, because we have a AAA sponsor as Sundaram Finance. So the automatic question that first we get asked in any fund is, capital to safe rahega, hai na? So, because you guys won't do stuff that's risky and so on and so forth. So I think, capital protection, returns, I think go hand in hand. So I think both of that is, quite crucial to the growth of this industry.
Got it. What do you think? We've been fond of each other. We've worked together for 15 years. So I was only telling him before we walked in that, we shouldn't make the other gentlemen feel envy of the kind of bohemia that we may have. Do you remember something that you would like to share? Something that, you wouldn't have shared with respect to industry, investors, their behavior, how quirky that they are, or IFAs?
Yeah, so I think, first of all, this is actually a role reversal for us also because for 16 years that I worked with Maneesh, most of the time I would have questions and he would have answers.
Oh God.
And here is an opportunity for him to ask and I'll attempt an answer. So I think, again, carrying forward from what Karthik said and the question that you asked on that side, I think fixed income, particularly credit point of view, the journey that I have seen the credit grow from 2010-11, almost non-existent mutual fund credit as kind of category to about 1,40,000-1,50,000 crore in 2018 at a peak. And during that time and post which what happens, I think what I have found most kind of strange is that even the large investors with 10, 20, 30 crore ticket size investment also in fund, really behaving like retail investors and expecting FD-like kind of behavior from a credit fund. So that was one of the most strangest things that I saw. Even the super rich investors had a lot of money, but not necessarily having that mindset the super rich. So I think that was the strangest thing that I have seen in the context of what we are discussing today.
Got it. So Karthik, tell me, given that you've been on the private equity, you have one sort of different headset, So when you look at private credit versus, let's say, private equity, everyone has a good sense of public equity markets and bonds, let's say public debt markets. Sort of, what are distinctions in these? Are these headsets as managers very different?
They are. So when I said private equity, I also did private credit as part of private equity, but you're right. It's an entirely different asset class. It's a different risk class. So, it's equity versus debt. So, totally different. So, the outlook from a time frame point of view, a risk reward point of view, the ability to absorb mistakes or the mindset, which will allow saying, okay, you took a call and that call might not have gone right, but at the time when you took a call, I'm not going to fault you for it. And as a LPGP conversation is more, I would say, prevalent in the private equity universe, whereas private debt, private credit automatically means that, you are supposed to be doing safer stuff. You're supposed to be backed more, whether by way of assets or cash or so on. So I think the outlook to private credit is more, okay, it's a little bit of like having the cake and eating it too, because they're saying that, okay, private credit kar rahe ho to private to return to aana chahiye, but safety bhi rehna chahiye. So I think a little bit of this overhang very prevalent, but I would say that, we've been in business for about 6 years or more. And in 6 years itself, which is a very short span of time considering, India, we've seen outlooks of LPs change. And a greater understanding, they're able to ask the right questions, they're able to due diligence managers more and more. I mean, it's not, I would say, at Western style, but certainly in the 6 short years, people are able to understand if this manager, this is what they do, this manager, this is what they do. So they don't, increasing at least to Bhavdeep's point, institutional investors, they're able to discern who does what better and whose cultural style is what. So I think to that extent, I think there is an appreciation, but obviously, private equity continues to be the mainstay within the alternates universe in terms of allocations. So many conversations I've had, people prefer that India is a growth market. So, obviously we should take an equity bet. So if it's not public markets, let's do private markets, but let's do equity. And I'd rather hit a sixer rather than do the ones and the twos. But I think that mentality is changing from a retail H&I perspective, but that's sort of where we notice.
Actually, it's good that you make this point of sort of let's hit a sixer. It's just for the context of people. We've done a detailed DD of last 40 years at IIM Udaipur CFR, and what we realize is that if you invest in a private firm which is not listed, 80% chance that firms will stop in existence in 20 years' time. So in a sense, mortality is very, very high. Whereas flip it on the private debt, let's say, it's 85 to 90% chance that the firm would pay and would sustain. So you won't lose money on a rolling 5-year basis. So essentially, private equity is actually a right tail event, whereas private debt is a little bit of a central tendency. So Karthik has moved from capturing the right tail traits to the central tendency trait. Is the other way I would promote him if you want to buy his fund. But Lakshmi, tell me, is that she has worn for a good 20 years, worn the headset of managing public money, public bond markets. She's our bond girl. They have Mr. Bond, we have Miss Bond. So what is the difference now that you look at private debt? How is the headset different in terms of the way you think, conceptualize the entire framework of accessing this market as an investor as well as, as an advisor?
So I'll say that, there is, and in this is just after lunch session, so I'll say that if the public debt market was Pani Puri, then the private credit market is vodka-infused Pani Puri, because nasha zyada hota hai, but the potential of getting that extra return is high, but when you get kicked, you'll get kicked really hard. That's in a lighter vein, but on a more serious note, 2-3 things which very clearly differentiates. One is you're moving from plain vanilla to slightly more bespoke. You can be slightly more bilateral collateral, so therefore you can dictate the terms of trade that you want, depending on the kind of check size, the ticket size that you are. So the largest fund that we manage is $3.2 billion, which is also in the credit space. And the lowest size fund that we manage in that space is close to $200 million, which is close to about 1,600 crores. So you are able to provide a solution capital from the senior secured, which is the closest to the plain vanilla, to probably more exotics, and go in for low cash coupon and go with an equity participation, or go for the subordinate debt and give some umbrage to the C. So you are able to provide for all of that, which was not really possible in the public debt space. So I think that I see as a tectonic shift. And mind you, contrary to popular perception that only Amitabh Bachchan can give hit movies, even Ayushmann Khurrana, even Ranbir Kapoor and even Ranveer Singh are all doing hit movies. What I'm trying to tell you is that even the mid-market companies are EBITDA generating companies. So the ambit that we operate in is today we have about 8 investee companies in the portfolio in the fund that we are just deploying. We're about 67% deployed, and there the average EBITDA is anywhere between $80 to $100 million. So it's a misnomer that only the well-established names in the public debt space are the ones which are profitable, and therefore they deserve access to capital pool. It is the I would say underrated or underdogs, which are in the mid-market segment, which are good quality businesses, but they necessarily may not be bankable, or they may not be end-use bankable, and therefore they find their way into the private credit markets. Fortunately, we have proliferation of funds today, which is allowing, and we've seen that tectonic shift from mutual fund credit in favor of AIF credit. So I think that's also playing its role in some sense.
So, the way of course, she has a lyrical and nice way of putting across this point that, she manages one of the largest credit fund, $3 billion plus, and that is Amitabh Bachchan. But she's also saying that, folks like us who are starting off just now, you can also invest there. Okay, it's okay. Like all her movies are going to be hit, but Ayushmann Khurrana, come on, so please write to me. So, Bhavdeep, you've sort of looked at me and investing teams, equity, debt, and of course, you made a point last week when we were chit-chatting that the rigor involved in actually looking at these minutiae of small firms in Nadanag. He's a CEO of, and you sort of looked at us and looked at these guys. How are they different? How the whole process of investing in relatively smaller firms, not the big boys. How is it different?
Yeah, so there are, because most of our audience also would be kind of familiar with mutual fund as well. So let me just use the framework that sort of we typically use in the funds industry as well, which is 4 Ps essentially. So if you just look at the team size and the significant sort of focus on the risk team. I have never heard in my funds experience of 23 years that investment team can be like 25, 30 member team. And the risk management team. And risk management team not only doing due diligence at the desktop level, but also at a on-field level. And not only once at the time of underwriting, but also on a regular basis. So I think that level of rigor is something which is new to me. In fact, I have not seen investment. Of course, I have kind of interacted with you, learned a lot, but I have not seen investment as closely as I get to do it now. But what I see is the rigor in terms of the granularity, for example. The average ticket size that we do is 20 crore. And the kind of due diligence that you see for the 20 crore underwriting of private credit, in terms of the structuring, in terms of the due diligence, in terms of monitoring, it's a very high-touch model. Also the utilization of tech, Maneesh, because it's a high-tech model in the sense that over the last 15, 16 years that Northern Arc has been doing underwriting, both balance sheet business as well as AIF business. We have got some 22 million data points of borrowers. So 85% of India's PIN codes are having our borrowers, and we have that data of how the borrowers are likely to behave. So to that extent, I think your ability to kind of project or predict some sort of or forecast the borrower behavior is something which we kind of get to use. So I think I spoke about the team, which is the the investment team, risk management team, also the ICs. So most of the global investors that we kind of work with typically would have insist on looking at the profile of ICs, investment committee I mean, and you know, what kind of experience that they have in that particular segment. For example, we are running a climate fund. So IC has to have climate fund deployment experience, that kind of rigor, right? So 4 or 5 member team, each fund has a separate IC. So that's the first P, which is the people part of it. The process side, if you look at the high touch, high tech model I spoke about. Also the most important element that I would want to highlight here is the fact that there are 2 ways to kind of do lending in my view. One is a lender's lens, another investment management lens. And here the approach to kind of give money is more of a lender's approach than the fund management approach. And that is fundamentally different. And then of course the portfolio construct, as I mentioned, the granularity, the coupon, the insistence on amortization, you know, so average ticket size would be 20 crore, as I mentioned. The average holding period or the term would be about 2 years with that quarterly coupon and amortization, etc. So that's what I really meant by the rigor that I saw in private debt underwriting compared to public debt underwriting. And of course, the performance is a common denominator in both the markets.
So, you know, so sort of what Bhavdeep says, and sort of I agree, that in private debt markets, or, you know, you essentially get a fund manager headset, which is agency headset, that he's accountable, but also get a lender headset in terms of actually getting to the detail of it. So in some sense, it's a bridge. A public money manager is a little bit of a meta structure, which is actually, it's all about relative pricing. Whereas a pure lender is all about detail. You know, guy who's doing a 15-year housing, you know, he's not interested, Ukraine mein kya hua hai, kal Russia mein kya hua hai, kahin kya hua hai. Public manager is obsessed with it. So what you get in a good private fund is sort of a bridge that, you know, which actually takes care of what's happening, which actually helps you improve the actively relative pricing, but also has a lender headset ki actually mein kisko dena hai paisa. So in some sense, it's sort of the way I see it, because, you know, me, Lakshmi, sort of come from the other side of the river, right, which is a public market. And I've shifted to private markets and see, you know, exactly the point that, you know, these folks do, which is a lot of rigor. Lakshmi, I have this sort of, again, for investors to understand, what do you think about the risk premiums? You know, because every asset is about risk premium. What do you think about risk premiums, that if you were to think of private credit versus public bond? A guy who's going to a corporate bond fund, and if he comes to your fund or my fund or his fund, Karthik's fund, what is that excess that he's looking for?
So if you look at a typical corporate bond fund or a sovereign fund or a mixed fund, for example, a combination of AAA, AA's in the public market space, the ballpark rate expectation, I'm talking about gross, would be in the ballpark about 8%, because the yields have crunched. Sovereign will give you 7% and corporates give you about 100 bips higher. In the private credit space, the potential to earn is almost double, which is in the ballpark 15 to 16% gross. And as I said, mind you, this is the well-managed EBITDA generating, positive EBITDA generating companies. If you go further higher, you know, if you want to really kick yourself higher, you want to have the purest form of dope, even in that space, it might be private credit, but it might not be entirely performing credit. There the ask rate goes even as high as 20 to 22%. So I think you have that entire ambit, but a broad rule of the thumb is that if sovereign is giving you an effortless 7%, the ask is, and on a post-tax base, and assuming the taxation is the same, so we'll just talk gross to gross, the ask should be at least a 3 to 4% extra minimum for you to be able to justify to take that additional risk. I think that is the, of course the thumb rule can vary for different investors, but by and large, today at this juncture, given that well, I can say that 15, 16 months back to today, the premiums have crunched, you know, because there are many, many more. Have you seen the movie Stree? वो picture आई अभी?
Stree 2.
सर कटे का आतंक, वो देखा है? So उसके पहले आई थी स्त्री, so this is a sequel to that. So पहले स्त्री में dialogue था, ओ स्त्री कल आना. That is the dialogue, and that was printed on the thing. So the credit managers or even the private credit managers had a choice to be picky and choosy. अभी थोड़ा time change हो गया है. अभी यहाँ पे wall पे लिखा हुआ है, ओ स्त्री रक्षा करना. मतलब आप पैसे लगा के अभी आप pray कर रहे हो कि भैया हमको time पे पैसे लौटा देना. So somewhere that crunching of premiums have happened, no doubt about it. But I think if you apply this broad brush principle that I need to get at least a 3 to 4% extra, then you can be picky and choosy about the fund or the credit that you want to own. But today, clearly with the proliferation of funds which are happening, every fly-by-night is launching a fund. One person is good, to launch a fund. People are not looking at infrastructure and stuff like that, which is also concerning a little bit. The premiums to our mind will only crunch further, and I think that's clearly a caveat.
So Karthik, tell me, this risk premium that she talks of, 7% extra, I mean, how can something give 7% more? What are the mechanics of it? There's a wall trade-off there that you get in equity, that you get 18-20% standard deviation and therefore it shall deliver you 4.5%. What is it? Why do you get 7% more?
Okay, so there's like 3-4 questions in there, but I'll try to be a little objective. So at least I'll tell you what we do, which is a partial answer to your question. So we operate credit funds which largely generate between 18 and 20% gross returns, portfolio level, which means with cash drag and everything, we haven't lost money so far, touch wood. Effectively, investors are making around 17% gross. Okay? And this has been the track record on a quarterly basis for the last 5-6 years. We attribute this principally to 2 reasons from our own perspective. One is that we operate in areas where there is an automatic regulatory arbitrage, and this is an important point for the audience to absorb, and it's also responsible as one of the key drivers for the private credit market or the alternates market in general. So in India, banks have been the preserve of the largest amount of capital and the cheapest cost of capital, forever. And they have funded everything from projects to equity to everything so far. That over the last 10 years, we believe maybe 15 years, is undergoing a systemic change where the RBI has stepped in and said that, look, as a bank, you guys are the backbone of the economy. So if there is a systemic risk to banks, that's something that I will consistently eliminate. So there have been a host of restrictions imposed on the banks by RBI, starting from sectors like real estate, end use of capital, what they can and cannot do, provisioning norms. 1 year ago, they banned even NBFCs from financing land. So there's a lot of oversight, hawkishness for the right reasons that the RBI has created, for the right reasons again, a very large arbitrage market. So essentially, it is pricing for providing liquidity for these end users. And India, if it's growing at 6-7% a year, and 40% of the economy or GDP is being contributed by SMEs and MSMEs and so on, they all require capital in various forms and fashions. So effectively, they're not able to go and access bank capital. They're not able to access public markets. They're not yet of the stature to raise public debt or public equities or even private equity. Then a credit solution or a structured credit solution is the best way that they can raise capital and continue to grow. So we've seen in our own portfolio, companies, which were probably, from a real estate standpoint, executing 2-3 projects are today executing 8-10 projects. They've gone from 1 million to 10 million square feet. In the corporate credit side, which is a fund that we raised last year, we do largely bridge financing, interim financing, short duration financing at 18-20%. Now, all of those companies are comfortably repaying, able to access bank financing at a lower cost. So there is a sustainable need for different forms of financing, which is really the trigger point for private credit to start, grow, and continue to grow in future. In our opinion, EY has come up with various research reports, but the latest one, I believe, forecasts private credit financing at somewhere around 60 to 70,000 crores per year as a credit demand, right? And that is something, overall, if you just step back, listen to everything that I say, in the US, 80% of risk financing is done by non-banks. Private equity funds, non-bank companies, curbside lenders, private lenders, whatever you may call it. In India, it's exactly the opposite. 80% is done by banks. So if you just say that, it's a convergence to the mean and, we are the most comparable market to the US, or at least aspirationally, this trend will continue going forward in terms of demand for capital and pricing for liquidity. There are other reasons, where, credit cycles, events, of course, growth and so on and so forth, which will make people or issuers or borrowers or promoters access capital that, are necessary, for, different kinds of growth, not just to do with regulatory arbitrage, but even, for example, we've seen companies which are 250 crores and below in revenue find it very difficult to access bank financing, or it takes an inordinate amount of time, simply because of the cultural way in which credit is appraised in the country. So it takes a very, very long time, and they can't wait for 8 months between sanction and disbursement. So they say that, okay, let me go and actually borrow at a higher cost from an NBFC or a private credit fund and so on, and then look for ways to replace it, pay it back fast, accelerate my business and so on. So there is a variety of these reasons which are contributing as triggers to the growth of this industry, and that's probably the reason why these kind of returns exist. Having said that, I totally second what Lakshmi just said. There are always, people who will come in fly by night, as she put it, who will come in and say that, okay, you know what, in the desire to grow fast, let me go and compromise and lend an 18% risk at a 14% risk. So we've seen that happen time and again. But these are cycles. It's necessarily part of the challenge. It's part of the business environment. And so those guys probably might not be able to raise the second and the third fund. So the consistency of performance, the discipline with which a manager is able to execute, whether it is Northern Arc or Kotak or so on, or ourselves for that matter, I think is increasingly the point that I was making in my first response, where I said larger LPs who are more accustomed to financing AIFs and private credit now understand who does what reasonably better, and they're able to discern. But for a larger proportion of the investing community to understand this, it will probably take a little bit more time, but they will get there. So I think that is what is sort of driving risk premiums still being attractive.
So, I mean, it's a long answer, but samajh rahe hain, Vinod, ki basically equity, you get that 4% extra over bond. Equity, you get 4%, 4.5% over bond for a trade-off. That is, are you ready to live with a 50% drawdown once in a decade, 20% drawdown once in 3 years? On average, 18-19% standard deviation. If you're ready with this, then the marriage is such that it shall deliver 4-5% extra over bond. That's the trade. The private credit trade is not wall. It is not that there's going to be a lot of volatility in outcome. Once in a while these NPA ratios, and we'll talk about it with Bhavdeep, but actually the private credit is delivering you for the excess premium, ACCESS premium, that stuff that banks can't do, MFs can't do, and only a small set of people can do, which is what Karthik does, Lakshmi does, Bhavdeep do. So for that thing, for unique thing that banks are not allowed to do, a lot of companies come to Karthik, and therefore he is able to charge. In some sense, it's a flexi capital equity substitution. So don't think in your mind that when you're giving to Karthik, and he's delivering you 17-18%, it must be something black box. It is a kind of an asset class which has an intrinsic bias of delivering more because there is a regulatory arbitrage to some extent. Now, Bhavdeep, I have to ask this question that 15-16% banega, but we know we've gone through this, that NPAs hota hai, to nuksan ho jata hai bahut. So what if there are losses, cyclical downturns, credit losses? What is the kind of impact a portfolio will have if there were to be an NPA cycle again tomorrow?
Yeah, so there are two things. One is, yes, I think the recent memory that of 2018, we have seen NPA levels of, gross NPA levels of 15, 18, 20% also. I think at that point in time, the scenario was a bit different. So let me answer you this question in two parts. What is the probability of that kind of NPA cycle to kind of happen, number one, and number two, if that happens, what happens to our investors' experience and their mindset, right? So first is that probability is very less right now, because then the situation maybe the debt to equity was very high at that point in time. Now, if you look at the mean debt to EBITDA level, that has kind of come down from 4.3x, which used to be there in March 2020, for example. Over the last 4 years, it has come down to 2.4%. So I think the starting point of debt to, I mean, the leverage ratio has been pretty decent at this point in time. Also, the culturally, I think both with the NCLT, for example, happening, I think there is a little bit of that fear amongst borrowers as well. The deleveraging that has happened, as I just mentioned. Also, the fact that a lot of lending had happened to corporate segment at that point in time. I think post 2018, we have seen more of retail lending based growth than the corporate lending. In fact, just to look at last 5 years of industrial credit growth, is just about 3% versus 15% of retail lending, right? So I think it's a lot more broad-based credit generation over the last 5 years that we have seen. So the probability of that 20% happening now is very less. Never say never in market context, but very low probability even that kind of rude and crazy NPA cycle will kind of play out once again. That's one. If even slightest of the NPA levels were to kind of go up from here, what will happen? So first of all, last 2-3 years have been very, very benign in terms of NPA cycle. We believe that the credit cost will normalize over the next few quarters, couple of years for sure. And this normalization will happen particularly more to start with in retail credit than in corporate credit. Mostly that's our house view. And if that happens, what happens to our investors' expectations? I think, of course, as Karthik mentioned, similarly, even in Northern Arc, so far we have 5 fully exited funds over the last 10 years, not even a single credit incident, leave aside default, there is not even a single day delay. And quarterly coupon servicing and we have seen demonetization, we have seen COVID, we have seen ILFS crisis, everything. So the track record so far has been extremely good of private debt. But what we do, Maneesh, is that that answer lies in the selling process. That can we really moderate the investors' expectations? They can't have FD expectation from a private debt, even if it's closed-ended fund. So we always kind of provide for about up to 1%. As credit cost provision and the reinvestment cost provision, pretty much the way we used to do in FMPs. So you provide for that. So whenever we kind of communicate a target return in a fund, we kind of have share of 1% from that, and then only communicate. And that is the reason why we have been able to deliver in all the fully exited funds return which is ahead of the target, because we did not have the need for credit cost provisioning. So I think to answer in a nutshell, we don't see NPA cycle to be as rude as it was last time for the reasons that just mentioned. And if it were to happen, I think the most important part is at the fund manager level, we have to be cyclically very aware and agile in terms of managing that part. And number 2 is expectation setting of investors and distribution, that don't expect FD kind of linear payoff. As you rightly mentioned, the wall might not be higher, but there could be an event risk, and you really have to be kind of come to terms with what this asset class has to offer. There is no 7%, 7.5% over bond. I think it just doesn't come free, right? At some point in time, it just plays out. So I think that understanding amongst investors and in our sales pitches is very, very important, is how we kind of look at it.
Got it. Lakshmi, same question, because, this is the top of the mind question, that what if things go bad? I know Bhavdeep is telling us it's super good out there. Wind is blowing, nice weather, no NPAs, everything is good. And Modi ji 3.0, his favorite Modi ji has come back. So anyway, how can anything be bad? What if it is bad?
Credit losses are inevitable part of any journey, whether you do it in the public market space, whether you do it in the private credit space. Pedigree definitely matters. There's no two ways about it, but that's not given as an assurance that nothing can go wrong. So I think when you are investing in these kind of category of funds, you need to be mentally acclimatized that it is high risk and therefore the high returns. Risk can be managed, risk can be mitigated, and therefore diversification obviously is one way you can, work around it. There is no cap around how much should one issuer be, like we have in the public market space. But willy-nilly, you see every, well-managed, pedigreed fund house put these caps internally, saying that there will be a sector cap of 20%, there'll be a stock cap of 10%. That is the real way you can mitigate this risk. But inevitably telling that गाड़ी लेके जाएंगे, ये तो Lamborghini है, इसमें scratch नहीं होगा, that is not going to be. Maruti हो या Lamborghini, scratch is inevitable.
So she's being very modest about it. Okay, I have to tell you something which is a better sales pitch. Is that, even if her portfolio had to have a knock of 10% NPA, which she will say will never happen, even then, it will only knock 2-3% off your returns. So to get to the bond fund's return, she has to have a knock of almost 20%, thing that, Bhavdeep is saying will not have a rerun.
Actually, Maneesh, more than that, we did a stress test to show that 1/3 of your portfolio needs to get impaired for you to be matching a bond fund of a return. So that is the acid test, if one were to look at.
So because SEBI doesn't allow to tell all this, which is why she is not telling. I have not launched my fund, so I can tell that itna nuksan ke baad mein bhi, you actually pretty much recover as much as you would do in the sort of safe haven asset. So to that extent, it's actually, there is a real genuine risk premium even in very, very bad circumstances. Of course, what may come to your mind is that 15% NPA पे तो बैंक उड़ जाते हैं, but because they are levered vehicles. So they are 6-7 times levered, and therefore at 15%, net worth is zero. But that's not true in bond funds. So Karthik, maybe last question. Within credit, of course, performing credit, venture debt, lots of stuff. How, in your mind, you would like to convey to people as to what is the fitment? How are the experiences different? What kind of risk across different categories of funds are?
Okay, I think fundamentally, I would like to classify the risks just as in any market as equity risk and credit risk. I think that is the first sort of litmus test. And that comes out of not an instrument. We could be investing in a non-convertible debenture but taking equity risk, for example. So I think the goal is really to understand what each of these categories, just to take off from what Maneesh said, if it's a venture debt, then effectively the risk that we are taking is an equity risk. So if that exposure doesn't get refinanced, the company is not growing, it's not IPOing, there's an event risk that will impact returns. Whereas on the other end of the spectrum, if it's a senior secured fund like what we run, where we are backed by assets, cash flow, consistently reducing risk every quarter, fully amortizing, not taking greenfield risks at all, and so on and so forth, then by end use and by behavior, the risk that fund does is a pure senior secured risk. So I think there are a lot of in-betweens between situation A and situation B that I described. And there are nuances where each investor, obviously there's 120-page PPM, but not all investors may read that. But essentially, I think what investors should look at is what is the kind of risk at the end of the day that fund manager is taking in that particular strategy. And if it's something that you're comfortable in terms of identifying that my equity risk le raha hu, so I should be getting higher returns, that's fine. But to say that oh, you're doing real estate, so you should be doing 22%, wherein we are doing a senior secured portfolio and not taking any typical project finance real estate risks, that is sort of a misnomer. So I think the understanding of the risk is something that is very important for investors, I would urge to go through and then make an informed decision on whether that return fits your allocation or not.
Good. So we'll have, if we have some questions, we're happy to answer, to the panelists. Anyone has question? Yes, please. Sorry? Tax, we don't answer on tax. But anyway, anyone wants to answer tax, please?
On separate maybe.
Separate, we should discuss separate.
It's a very touchy-feely topic on tax, but some categories are passed through and some categories are passed through and some of them are tax exempt. The category 3, which largely has equities, public markets equities, it is tax exempt. So that is taxation at your individual.
The complete pass through.
Yeah, it's a complete pass through. Yeah.
Sorry, the question I had was, private credit is still not a very large space. I mean, it's new, evolving. You may be able to cherry pick a portfolio to the extent that you can. Over a large portfolio, over some period of time, do you see the necessity to be able to participate in an organized, legal collection-based process like SurfaceE? Would that become necessary at some point in time?
Okay, I would have to say, sir, that everything that is being done in the private credit universe today is extremely institutionalized. There are formal escrows like any bank would. For example, we lend as a senior secured lender, where we are sole charge. If you went to a sub-registrar's office and checked up a charge, the fund would have the charge. We have a legitimate escrow with the bank to sweep the cash flow, just as a bank would. So I would think that from an operational behavior point of view, the AIF industry, which was, as you rightly said, zero about 10, 11 years back, is now, I think my colleague Vikas said in the morning, of 11 lakh crores. I mean, it's roughly 22% of the mutual fund industry. So I think it's grown in scale so rapidly, and so it has to get institutionalized from a behavioral point of view. So as I said before, some of the risks that an AIF Cat 3 fund would take or a private equity fund under Cat 2 would take is an equity risk by its very nature. So from that point of view also, the SEBI is also the regulator for the AIF industry, just as it is for mutual funds. So from that perspective, it's a highly regulated, we have annual audit just as a mutual fund would have. So all of the compliance and appendages that go with governance and so on is something that is very much inbuilt into the space. So from a lending perspective, at least what we do, and I understand your concern, is exactly like a bank. But yes, there are funds, which do unsecured lending, bridge financing, sort of curbside, as it is called in China, the US, and so on, which is akin to a private lender. But then the risks, as I said, a few minutes ago, is something that, one will have to see in terms of, what is the process that particular manager goes through before they lend. But the industry, I can say, is by and large highly institutionalized right now.
No, and in a very lighter vein, maybe if we had this conclave about 5 or 6 years back, this industry would have been akin to Lapata ladies, but today it is actually Mission Mangal.
So this is
Well,
this is
yes.
all. Just a small point, just for everyone understanding, you'll be surprised that very large NBFCs would end up using the same vendors that Karthik would be using. So even though they're very large, for them it makes sense to go to super specialists for conveyance, for monitoring, for escrow, for everything is plug and play today. So Karthik or Lakshmi or Bhavdeep sit as meta structure on top. So what you're paying them or you're giving money to them is for better processing power. Everything else, infrastructure actually is common that, perhaps even HDFC uses that he'll be using. So that should sort of, bring down the overall anxiety that you may have that how your money is being treated. But with this, we should end.
Actually, I know we don't have, we're running out of time, but just one last question to you, Maneesh. I think, and there's an elephant in the room during lunch break. Sorry, Prem, I'm just going to take 5 minutes, but it's very interesting. Lunch break, quite a few friends I spoke to, and their point right now is that the equity has so disproportionately kind of compensated risk to the investors over the last few years that it's not about comparison of credit with bond. It's about how do you really, people are finding it very difficult to even bring down investors from small cap to large cap and even BAF. That is the kind of risk appetite customers have. How do we really look at private debt in that in the space of asset allocations? What would you tell to?
I'll tell you a very small thing. Go back and do a 20-25 years of nifty 3-year rolling return, and you will be shocked with the results. This is a homework for everyone. Okay, the beauty of equity is that if you have a very long horizon, there are 6%, 5.5% excess return over bond to be extracted. But you have a 3-4 year horizon, the math changes. That number is half. So, and unfortunately, an average investor, not just in India, but across the world, has a horizon of only 3 years. So 3-year excess return over bond of Nifty is only 3.5%. But you go and check this number, and that is where the answer is. Lakshmi said that she'll deliver 6-7% more. But Nifty, if you are a 3-year owner, irrespective of today's valuation, will perhaps only give you 3.5% on average. That's the median excess return over Nifty, Nifty delivers over bond.
Well, thank you so much for such a fantastic session, and Maneesh, I must say, a very entertaining session.